Okay. Hey everybody, welcome to the live stream. So if you want to donate, I could do a DCF on demand. It takes about 5 to 10 minutes. And we can just look at the market today. It should be there now, right? Do you hear? Hey, just confirm if you can hear me now, because I added the sound. Okay. I don't know how many times I'm going to do that until I figure it out. Hey, Kevin. So, I was looking at Redbox. I was working on a video today on Redbox. Redbox, it's a kiosk. You can find them all over, and then you go to the kiosk and you could rent a DVD, a movie, or a game. Chipotle. Yeah, if you want to donate to the live stream, and I'll do a DCF right now. It takes about 5 to 10 minutes. So Redbox was acquired in October of last year, so just a few months ago. They're a SPAC, so they got acquired. Hey, Sahil. And let me go to the bigger chart so it's easy to see. They got up to 15, and then they fell to below $2. Like most SPACs, just kind of crash. But Chicken Soup for the Soul, that's a company. They announced they would acquire Redbox for $375 million. So the stock has gone up the past couple of months. It's back up to almost $7. Citigroup, okay. We'll start with a hard one. Okay. Okay, the WACC of 8.3%. Okay. The reason I say it's hard because banks aren't usually the best candidate for a DCF model. Revenue in 2023 is $75 billion. And revenue in 2022 is, hey Doc, what's up? $73 billion. I try to set up my Excel file so everything is kind of streamlined. Why is that? Sorry, I just got a text. Let me just respond 1 second. Do you sell? Yeah, you could get it on Patreon if you want. Remember, $5 a month. at the lowest rate, and you can get. I have a DCF more user friendly on. Well, because let's do DCF. It's before I try to explain why insurance companies and banks aren't ideal for DCFs. Does anybody know why a bank isn't a good candidate for a DCF? I think, yeah. Let me think better how I could explain it. Altria. Yeah, I set it up, the DCF, so I don't have to click through this thing. Complicated financials, that's part of it, but that's not really the reason, because lots of companies have complicated financials. Think of the like how a come on. Think of how a DCF is used, the purpose of it. You forecast your future free cash flows. If you provide a loan to somebody, right? Say that's your business. Say you have this little side business that you provide loans to people. And then when people, I mean, the idea is you have access to capital at a say at a 5% rate. You can get as much capital as you want at 5%. And then you lend money out to friends, family, whoever at 8 to 10%. And you're the interest spread between what you get the funds at and what you lend it out is how you make money, right? So do you see how that might not work in a DCF? I'll explain it in a second. Because say you started your business today, right? And you lent out $10 million. You don't really have any cash flows coming in, like very little, say, because you're still building up your portfolio. You have to kind of, your business is not totally based on cash flows. It's a lot based on when they pay the principal back and the default rate. So it's a lot of nuances that don't really work. Because when you make a product like a car, it costs you a certain amount of money to make that car through labor and parts, and then you sell the car, and you sell lots of cars. That's the idea. So it's kind of like an easy way to identify how your cash flows come in. Where when you loan money out, it's a little more complicated. But it's not. It's the same purpose. You're still making money. You're still looking to. So it did work in this case. We're getting a normal value. But it could be really lumpy, because could you imagine, like, if you had say you had $100 million of loans lent out to people over 10 years. That's your portfolio. And then one day you get a really big client, like a huge conglomerate, where you lend them 500 million. So it's very skewed towards that one client. But it's hard to explain. Plus, you have derivatives, swaps, and hedges, and that you have to build into it. It gets a little confusing. So the best way to value a bank is look at the price to book. Wait, let's see. Let's just get this set up so we can. MO. Why did it? Okay, C. I thought it was C. I don't know why I wrote CITI. Okay. Okay. So we are getting a good value. $75 is the model says. 53 is what they're trading at. So they're trading at a 30% discount. And another thing that's not as easy to explain is that you have to value or mark to market your portfolio of loans. So you might have one quarter or 1 year where you show where it appears that you lost a lot of money, but you actually didn't lose. You might not have lost this money. It might be due to valuation. Like if you own a stock, say you have $10,000 of Facebook, and you might report this quarter you have a loss of 3,000, but you didn't actually sell the stock. You just have to value the stock. So you're showing huge losses. I don't know. It's kind of hard to explain, but valuation is in mark to market, unrealized gains and losses skew the numbers as well. But the best thing is the price to book. That's how you really value insurance companies and banks, and they have a really good price to book. And I actually bought the stock a few months ago, and then I don't want to say what I sold it for to buy. Oh no, I bought Google. I sold it to buy Google, so it wasn't bad. But yeah, they have the best one of the best price to books, and that's how you. But price to book is. You know what price to book is, I'm sure, but I'll just say it. Market cap over equity. Valley Carpentry, thanks for being a member. So we know the market cap, that's what the stock is trading at in the open market, but the equity is what the company's worth, the balance sheet, assets minus liabilities. So you have to look at the balance sheet and understand the assets, understand the loans, or understand how much risk they have in the open market. Because if they loan money to a lot of risky companies, maybe this 0.5 is not so good. Maybe Bank of America's 1.0, which is a worse price to book, is actually better because they're lending out to less risky people, so they're more likely to get paid on those loans. But even better is tangible price to book. Let's see if this. I don't see it here. The tangible price to book. But Citigroup is just a giant bank. I think it's a pretty safe one to invest in. Okay, Mo, the tobacco company, Marlboro's, Altria. If you could do Chipotle and Ericsson, you've done Ericsson before, but they've. You have to donate to the live stream. Mo is a cash cow. When you sell a vice product like tobacco, alcohol, or gambling, any vice product service where people need it, they need to live. It's like water for people, tobacco. You're gonna make a lot of money. People think of tobacco as food, like they need it. It's part, they have to live. So all these vice products, all these addictive products are very good for. The only reason I don't buy them is because they don't get as much exposure as a non-vice product, like a tech company, because some funds won't invest in tobacco or cannabis type products. They pay pretty amazing dividends, so I guess. I'll do Chipotle since you joined as a member. Let me know if I mess up, because it's easy to mess up when you're talking and doing this. Look at the cash flows. $8 billion, $7-8 billion. Lots of cash. They have half the cash flow at Citi. But look how small their revenue is compared to Citi. They just look revenue of 21 billion, cash flow of 8 billion. Like it's all margin. I mean, look how high that margin is. It's crazy, right? Did you study finance? No. I mean, you don't learn anything from studying in school. You'll never learn anything. You have to just do it. You have to live it. Like what we're doing, talking about stocks, investing, trading. That's how I learned. It's pretty much not reading any books. You'll never learn anything from a book. You have to apply it to a real life scenario. This is what you would expect from Altria, and a really undervalued stock, because the stock price should be a lot higher than what it's trading at. But look at this. Look at this dividend, 7%. So you're guaranteed 7%. So yeah, so it's probably always going to be undervalued because, like I said, big funds, there's a lot of big funds that won't buy it because they have to buy within a certain like ESG. So they, I wonder why they're, NLS? Well, their free cash flow is about average. They're not growing. What? They're really, do they buy back a lot of stock? Is that why they have a negative equity? I didn't realize they had negative equity. They have 28 billion of debt. Yeah, they buy back lots of stock. So if you see a company with negative equity, a lot of people say that's a terrible company because this implies their liabilities are $1.8 billion more than their assets, negative equity. But that's just because they bought back 37 billion of their own stock. They didn't have to buy back the stock. If they didn't buy back the stock, they would have a ton of equity. They could just turn around and resell the stock into the open market if they needed the cash. So if a company has negative equity, look how much stock they bought back. If they didn't buy back any stock, then yeah, maybe that's not good. Like Boeing and Starbucks, they bought back so much stock. So this is what companies do. They start with a small dividend and then they increase it a little bit each year, like 5% a year. Because if they drop their dividend, if they cut it down to like 80 cents, which is still a good dividend, then the stock would tank because people would be concerned something's wrong with the company. Okay. Chipotle. Is that CPX? Chipotle? CMG. I wonder why it doesn't have a. I don't know. It doesn't really have. That's just weird. Let's see what the WACC is on here. 6.45. That's kind of low. Let's do 7. It's so good, Chipotle. Have you been there? I used to always go there for lunch. It's not. It's a little pricey, but it's really good. The only reason it's so high, the stock price, is because they don't split. They never split. Like if Apple never split, one share would be like $50,000. Market cap is 36 billion, which is not a huge company. It's just because like Berkshire Hathaway never split. That's why their stock price is so high. Because they're a big company, Berkshire Hathaway, but there's plenty of companies much bigger. Like Apple is much bigger, Microsoft is much bigger, Google is much bigger, but their stock price is a lot lower. I just set this up, so I don't know if you remember last time. It took a lot longer to pull this data in. I just set it up so it just pulls in the correct cells. Oh, South Africa, like Charlize Theron. Wait. Okay, I took. Yeah. Keep an eye out and make sure I took the. See, you see, this is a normal company. 7.8 billion of revenue, 800 million of cash flow. So that's about 10%. So they convert 10% of their revenue to free cash flow. When we look at Altria, what was it, like 40%? I think 7 is a good whack. I mean, even if you went to 6, it's still overvalued. Slightly overvalued. Let's look at the. They don't pay a dividend, is that right? They don't pay a dividend. Okay. Everybody else pays a dividend except them. Starbucks is triple size. McDonald's is 5 times as large. See, they don't generate nearly as much cash flow as McDonald's and Starbucks relative to their market cap, or Yum. I'm not sure the difference between Yum Brands and Yum China. So they generate like the worst cash flow, except for Yum China. But they're growing. See that when you see like why is the stock price higher than what it's worth is because they're growing at 12%, and that's what investors look at as the future. Once they stop growing, then the stock price will come down, and it won't be overvalued. NLS. Nautilus. 9.3. BBY. Okay. Nautilus. Small company. Sheesh. We are generating positive free cash flow. Yeah. For some reason, simply Wall Street, Yahoo doesn't have their 2021 financials updated. I could just manually do it. It's not hard. Because they only go to 2020. You see trailing 12 months is the same as 2020. But you can just sum up the last 4 quarters. So you rate this. Yeah, they appear overvalued. Leisure. They're not even showing up in this. Oh. Okay. So you can't really look at their ratios because they're. I also need the. I need the to look at all the companies in the industry to figure out the average free cash flow over revenue. What percent the average company converts revenue to free cash flow? So it's about 8%. Because this company is negative. Although I could. Okay, obviously it's a risky investment, but if they get back to that 62, because they had 62 million free cash flow, it looks like in 2020. if they get back to that, let's just say they have negative for the next 3 years. Even if they get back to that level, this would be in 2024 and 2025, then the stock is worth $24. I think they have their market cap in cash. Yeah, 79 million market cap. And let's see how much cash they have. So they have 18 million at the end of 2021. They may have posted their first quarter earnings. And Yahoo Finance just didn't update it. We could look. No, the latest financials are 12/31. Yeah, so the latest that we know of is 18 million of cash. So they don't have as much cash as their market cap. But when you invest in a penny stock, you're either there's probably like a 5% chance you'll like 10x and a 95% chance you'll never make anything. I mean, I don't know the exact percentages, but that's generally what it is. It's kind of like when you gamble. There's a small percentage you're going to make a lot of money, and a high percentage you're not going to make anything. But I'm not. Is this Nautilus like the workout equipment Nautilus, like when you go to the gym? But yeah, you just want to learn more about the company. Let's see. Yeah, we can't even, the price to book is 0.5. I mean, they do have lots of revenue. I mean, look at their price to sales, 0.1. Is this a SPAC? No, it's not a SPAC. Yeah, but yeah, it could be a home run. Who really knows, right? Best Buy. $53.54. Everybody likes Best Buy. 15. Specialty retail. Let's see. Okay, positive free cash flow. So that's good. Yeah, Best Buy. Costco's this week also. There's a few big ones. That's crazy. Two. They seem really undervalued, but no, the DCF is just only one tool. Because as we know, DCF, looks into the past to try to predict the future. Look at that 6.5 price to free cash flow. The average is 20. I wonder why it's so undervalued. They pay a good dividend. I wonder why the P doesn't show up. Oh, that's why. Yeah, I mean, it seems really undervalued. Oh, it's one of the stocks that crashed. So slow. It was 136. It was 136. Now it's, yeah, a lot of these retail type stocks are getting killed because of inflation. They'll rebound though. All they have to do is just raise prices. when you have to pay more from your suppliers for products than you did before, then you just have to raise prices and charge your customers more. But it seems really it was actually, I forgot to change it. That was from the last video, but yeah, it's hard to predict this stuff, but yeah, it does seem undervalued. It's usually, was there another one? Best Buy. Yeah, like companies like Costco, like really good companies like that got their stock prices got beaten down because of all these companies in their industry reporting weak earnings. I think there's really good buys, really good opportunities. I mean, look at that. I mean, it was just a couple weeks ago, 570, and it got cut 150 points, and it didn't even it didn't even report earnings yet. The some of their competitors did, so their stock price just went down because the market's expecting them to report weak earnings. Before I look at the DCF, my first thing is I look at the company. If I understand what they do, that's the first step. Like Palantir, like I did buy the stock, but I don't really understand what they do. I mean, I kind of do, but it doesn't make, like if I understand what they do, I see a future. Like companies like Costco, I get it. I see the importance, the demand. I see them being around for a long time. Of course, like a restaurant, everybody eats. Of course, everybody's gonna go to restaurants, but like not every restaurant will survive. So you have to then dig a little deeper to understand how the restaurant runs their business. Hey, Will, what's up? Savvy Money Show. Everybody subscribe to Savvy Money Show. And if you have a YouTube channel, leave it in the chat so everybody can subscribe. Inflation doesn't really, you can't really adjust for inflation because with inflation, revenue tends to go up as prices go up, and then free cash flow goes up. At some point, initially though, what's happening with like a lot of these companies like Costco is that they have to pay more money for products because of inflation, but they haven't charged their customers yet more. So their margins are getting cut down, but they're going to all adjust over the next few quarters. They're going to start raising prices on all their items to be more in line with what they're paying. But when things change so quickly, they just don't have a chance, and they have a bad quarter. But once companies adjust, nothing's forever. Anytime something bad happens, whether a company goes bankrupt or even a country goes bankrupt, it just initially there's a lot of shock and uncertainty, but then things just adjust and they're just back to normal. Yeah, Greg, no problem. Let's see what. Yeah, like I said, so I look at the company just to understand what the company does, and if they're scalable, if they're a really scalable company, a lot of, like a Facebook type company, they're really scalable, very easy to scale and grow. Tesla is not as easily scalable as Facebook because you don't really need much manpower to start to sell ad space on your platform. But it is a scalable product. But when you look at a company like Uber, I don't think it's as easy to scale as like Tesla, because you need to have a person every single ride. You have to have a person transporting another person. So you just need more manpower. And it's not like a sticky industry. It's not like if you're working for Uber, you're not like 100% committed to Uber, because if Lyft starts paying better rates, you could just start using Lyft more. And most people who drive have both Uber and Lyft. So you're going to go wherever you're getting more money. The driver, I mean, a person driving a car. So let's see. Yeah, Redbox is up 28% because I guess the acquisition from Chicken Soup, was that today? May 11th. So that was May 11th. What's today's date? 23rd. So a couple of weeks ago, they announced the acquisition. VMware is up 21%. They should be reporting, I think, Wednesday, VMware. BTCS, I did a video on BTCS. Their crypto, kind of like Coinbase, I guess, but a lot smaller. If anybody wants a DCF, yeah, you can just donate, and then I could do DCF. What else is up? Greenbox, never heard of that. Ross is up 11%. I think Amazon's down today, which everything's up, but Amazon was down when I looked at them earlier. Yeah, they're down today. I don't get that. Purple Innovation. TK Tankers. Yeah, I saw other stocks in this industry up today. Toll Ingredients. Let's see who are the losers for today. You always see pharmaceuticals up a lot or down a lot. That's because anytime they have a drug that gets like approval, like moves through the stages of the FDA process, they go up a lot or down a lot. Shipping companies as well, paying great dividends. Yeah, shipping companies like Zim, especially Carvana, the car company, that's down 10%. The Container Store, RSI, Relative Strength Index. Is that what that is? RSI. Well, that's the REIT, right? That's the RS. What is that? Rush Street, yeah, Rush Street. Rush Street Interactive, 609. Yeah, I remember doing a video on them. I think I did one or two. Gambling. So I don't know if you guys noticed, I set it up where I kind of streamlined all this stuff. Because I used to have to manually pick each field. If anybody is timing this, let me know how long it takes from beginning to end. I think I got it down to like 3 or 4 minutes now. So they have negative free cash flow each year. So let's see what the average. So assuming they grow at this pace and hit 1.1 billion by 2025. This is the forecast by the company, the actual forecast. And they get the positive free cash flow at some point. And I'm the most conservative I'm doing is 2025. So I'm assuming they have negative before that. Then they do appear undervalued. Yeah, we can't look at the price to sales is really good, better than average. So they're bringing in more revenue than like DraftKings, Churchill, the top 3 companies relative to their market cap. Yeah, you can't really look at the ratios. But I like gambling. I think it's fun, and I think it's, whether we're in a really booming economy or a depression, people like gambling. But like I said, with these vice stocks like gambling, tobacco, cannabis, they don't get as much exposure by big funds. But let's see. But once they become profitable, I'm sure they're going to pay a dividend. Okay. Let's look at that balance sheet. $200 million of cash, lots of cash. What's their market cap? $75 million of equity. They don't really have any debt. 1.5 million, so pretty much debt free. But that's what companies do. When a company's in growing and they're not generating positive operating cash flow, they issue stock. They dilute shareholders. But once they become profitable, then they'll start issuing debt, because you don't want to issue debt if you don't have positive operating cash flow, because then you can't pay the interest on your debt. So the only way to pay the interest is to take on more debt. But if you see a company with negative operating cash flow like them and adding lots of debt, then they're in trouble. Bankruptcy is looming. But you got to issue stock, because stock, you don't have to pay dividends. But you're getting diluted whether they use debt or equity. You don't see it with debt, but it's the same result. The stock price will go down if they start adding lots of debt. Plus, they'll have less cash flow because they have to pay the interest on the debt. So cash flow is lower when they take on debt. So it's like 6 of one, half of does near the other. It's the same thing. But it's tangible. People see the shares outstanding going up, so they think it's worse, but it's the same thing. But if you're a healthy company like Apple, look how much debt Apple has. They have $125 billion of debt, because it's a cheap way to finance your company. And look how much stock they bought back. In 2018, 72 billion, 2019, 66 billion, 2020, 72 billion, and 2021, 86 billion. They buy back so much stock. They're adding debt. And it's not like they're adding debt to buy back stock. They have so much free cash flow. Debt is a cheap way to fund growth. As long as you can afford to pay it back. And if you look on their balance sheet, I don't know if we get the detail. I just did the video yesterday, so it's coming out. Look how much money they have invested. These are kind of liquid type investments, 128 billion of investments. These aren't risky investments. It's just so they don't sit on cash. They can earn a few percent of interest on the cash. So they have more investments than debt. So if your friend said he owes $100,000 on his house and he doesn't have any investments and he has $10,000 in the bank in cash, you'd say, that he has a lot of debt, right? But if your other friend said he had a $100,000 mortgage and $200,000 invested into the market, you'd say he's in good shape. He's pretty much debt free because he could pay off his debt if he wanted to. He chooses not to. That's kind of what Apple's doing, because they get debt at the lowest rate. They pay the smallest interest anybody can pay, probably. Like if you took a personal loan, you might have to pay 10%. They probably pay like 2%. Because they're like zero credit risk. And you ever notice Apple has no goodwill? Which is amazing. They have no goodwill. So pretty much all their growth is organic. They do acquire companies, of course, but they never pay more than a company's worth because they don't have to. They don't have to pay a premium for another company because they have all this knowledge. They just need to acquire certain companies to get more resources, but that's why they're the biggest company in the world. Did you know they're rated a strong sell? They're rated a sell now, Apple. I wonder why. Apple rated a sell because analysts think if SPY goes to 365, Apple. Well, yeah, I guess. I don't know. It just seems crazy. Is anybody invested in Redbox? Does anybody follow Redbox? It's kind of like Netflix, except they have kiosks where you go and you rent videos or games. Actually, McDonald's started Redbox in 2002. So you can go to these kiosks in like a mall or a supermarket, put your credit card in and rent a movie. You get the DVD, and then you could just drop it off at any Redbox kiosk you wanted to. They were actually bigger than in DVD sales than Netflix and Blockbuster at one point. Redbox, but they're a SPAC. I wouldn't touch them. I don't think it's not a bad company, but to invest in, I don't think it's a good investment. But plus they're losing money from the physical kiosks. They're losing money from that. They are starting to make money from streaming. So if they grow their streaming network, but a lot of competition with Netflix and Disney for streaming. AT&T at 21. Sheesh. Oh, it's not bad. I thought it was hot, like 25 a few months ago. It was always around that price. Yeah, savvy. That's how you learn. You gotta take risks sometimes. Play some options, and if you make a lot of money or lose, if you make money or lose money, you'll probably remember that. And it's just more information. You learn more, and you're a better investor. Look at Tesla under 700. I saw I can't remember if it's Hulu or Netflix. I watched I can't remember which one it was, Hulu, but it was like a documentary on the autonomous car, Tesla's autonomous car, and how they were taking a lot of shortcuts and
a lot of people our age. Star Shannon, and it's time to play. The following is
I don't even see it here either. Yeah, it was interesting. I don't know if they talked a lot about this one guy who died in a Tesla autonomous car, but people are going to die in autonomous cars. You can't, a lot less than, because people die a lot in cars, like every day, every 5 minutes, someone probably dies in a car accident. But that's going to greatly decrease with autonomous cars. But if anybody dies in an autonomous car, then that's all people talk about, like a plane crash. Like there's so few accidents on a plane crash, but when it happens, it's like it's all over the news. Same thing if somebody uses marijuana, like, and something bad happens to them, it's just all over the news. Palantir is on $8. Oh yeah, Tesla. How low would Tesla go? Do you think it'll hit 500? It was 1,200 at one point, right? Over 1,200. So it's back to where it was at the end of 2020. It's back to where it was. So if you were smart enough to buy it at the end of 2020, you were up 100%, but now you're back to where you were. But if you bought it any time before the end of 2020, you're definitely up, and you could be up a ton if you bought it in 2019 or 18. My friend got it at 50, a lot of shares at 50, and then he bought more at like 200-300. So I know he's definitely up. But it's hard because even if you got it in like 2013, these are just obviously a stock split adjusted. So it wasn't actually trading at these levels. But when you adjust for stock splits, in today's dollars, it was worth 25 in 2013. I mean, if you could have sat on it for like 5 years and made 10%. Like it's hard to it's hard to know when the big surge, if it would ever happen. So you could feel you're wasting your money. And even if you bought it and after 5-6 years you double your money, you might want to just take your gains. And who knew it was going to increase 2,000% in like 3 years? But I think my video was I think I had Tesla at 500. The video I did. Here's of future free cash flows. We also estimate they'll convert. I had it at 483 in January of this year. I had a 483. That was my target. So it's getting there. It's getting there. So if you believe my model, then yeah, you want to pick it up around 500. But who knows? It might go down to like 300. Yeah, Joe. Yeah, the T spun off. It's Warner Brothers division to Discovery. When is that going to happen? I don't think these things take a long time. Did it actually occur yet? Oh, it's complete. Okay, it is completed. Okay, sometimes it takes like a year for these things to happen. Yeah, I did a few videos. I learned something new. They did a reverse Morris trust. Am I saying that right? Reverse Morris. I never heard until AT&T. That's just to simplify what a reverse Morris trust is when you spin off a company and you don't have to pay much in taxes. That's pretty much what it is. You're spinning off. Well, when you spin off a company, it's like you carve out a piece of your company and make it its own entity. That's what a spinoff is. So if you have a company with 3 divisions, you could spin off one of the divisions, and that one division is its own company. It's trading at, it has its own ticker. It's totally separate. And then the 2 remaining original other divisions are still with the parent company. So they spun off the Warner Brothers division, which includes HBO, which is the most valuable part of Warner Brothers. And they combined it with all of Discovery, the company. And I don't know I forgot what the percentage is, but if you own AT&T before the spinoff, now you own AT&T and you own the Discovery, the new Discovery. I think it was like 65%. AT&T shareholders get 65% of the new entity, and you can correct me. And Discovery shareholders get 1/3. Yeah, Reverse Morris Trust allows the company to spin off all of its assets and avoid taxes. The RMT starts with a parent company looking to sell assets to a third-party company. Division company owned 71%. So the AT&T shareholders get 71% of the new entity. So you retain your AT&T stock, but you also get stock in WBD. Because a lot of people are upset, like my stock price has gone down because they spun off this company. Right, your stock price went down, but the end result is you have the same thing, except now you're split into 2 companies. Let me just see. I did in February. Lumen, yeah. Lumen's good. I like Lumen. Their revenue goes down for the past few years, but they're still profitable. I forgot how many shares of AT&T you need to hold to get shares of. Lumen. Yeah, AT&T pays a big dividend. And yeah, a lot of people were upset because AT&T was paying like 8 or 9% at one point, and then yeah. But like I said, it doesn't matter. You're just getting. You get the dividend for the new company and AT&T's dividend. find that video. I thought it was Lumen. Maybe it wasn't Lumen. If anybody wants to donate, and then I'll do a DCF. It takes less than 5 minutes. NVIDIA. That used to be the #1 semiconductor company, but they're down 50% since November. So TSM is back to #1. They're a little bigger, TSM. That's a good industry if you want. So, like I said earlier, sometimes I look at the company or the industry if I see a lot of future with an industry. Like if you were investing in the 1980s investing, maybe companies that make VCRs or rotary phones, maybe you could see like those companies may not be around, or that industry. What if the internet becomes free? It is free, the internet. What do you mean? Oh, you mean we don't have, you mean right now we pay Comcast or AT&T like monthly so we can use the internet? And you're saying we may not have to pay? Well, I guess those companies, they do make money on other things. Like my cable bill is, like HBO and those channels are really expensive. Yeah, I mean, I guess if you didn't have to pay, I'm trying to think, how can you not pay for the internet? It's like, I'm trying. Yeah, it's just hard to imagine that. Greg, thank you. Thanks for. SWBI, Smith & Wesson. Yeah, I mean, things shift a lot. Like, who knows what the future. It's kind of like we used to have to pay to trade stocks. Now it's pretty much free. We don't have to pay a fee. Did you SWBI, or did you mean WBI? Was that a dollar sign? All right, thanks for what you're doing. Okay, I got it. 673. don't know what to do. So the revenue is forecasted in they did generate 1.1 billion in 2021. The forecast in 2022 is 860 million. Then it goes down to 674 million. I'm not sure why it's going down, but that's what it is. Cash flow. Gun sales spike when people fear Democrat gun. We're gonna ban guns. No more guns. We don't want any guns, so anybody can just come in and just take over our country, and we can't do anything. We just have to. We can't protect ourselves. Yeah, POW. I like POW. I wonder why their revenue is projected to decline. I think I did this again. I think I took the net income instead of the revenue again. So annoying. Stupid. They have a lot of free cash flow. It seems really undervalued. Look at their free cash flow, 200 million, and their market cap is only 626 million. I guess because people think their revenue is going to decline a lot. I wonder why it's supposed to go down so much. If it continues going down, I'm gonna continue that trend of a declining revenue. It still seems undervalued. Even a more conservative model, I'm at 27. They're trading at 14. So it was 35 at the peak, and it's down like 70%, or 60% maybe. And they pay a 2% dividend. I wonder why it's... Oh, divestment? They're selling off? Divest Thompson Center Arms. Thompson Center Arms should rest assured that they will continue to receive the world-class firearms. We remain fully committed to hunting. At this time, a buyer for Thompson Arms brand has not been identified. However, the investor is not expected to have a material and financial impact. So they're trying to sell Thompson Center Arms. And that's going to really... Yeah, I mean, so generally, you don't want to see a company selling off parts of its business. That's usually not a good way to grow and scale, but you have to trust management. They're doing this to improve the company in the long term. I'm sure they explain it that way, where this is a good move for the company, and ATC is a niche product. I can't believe the sales came. Yeah, that's crazy. So it does seem undervalued, even in a even if I assume they're going to lose a lot of free cash flow from the divestment. But you know, but the market kind of looks into the future. So this is obviously a negative for investors when you sell off part of your company. But once they start increasing revenue again, whether it be in 1 year or 2 years or 5 years, then the price will start going back up. Let's, yeah, their revenue is declining 13% the past 5 years on average. But they're increasing the past 3 years. But according to this, it's down the past 5 years. At least they pay a dividend. Let's see it. Let's see, AT&T is up 2% today. SoFi, are they even up? They probably went down since they got the bank charter. Everybody thought once they got bank charter approval, they would start going up. But I think it's pretty much only gone down. Well, it's up the past month. Uber. Uber's down over 50% the past year. It's trading below its IPO price. Like 40% below its IPO price. Nordic American Tankers is down 11%. Meta's up. Cisco. JP Morgan's up 7% today. ET. Okay. I guess if there's no more, if there's no more donations, I'll probably sign off. More. That's down a lot, right? I like fell off a cliff. Okay, I think I'm gonna close out and have lunch. So thanks for joining. Thanks for donating. If you want like a quick DCF, I could probably do it over email. I'm gonna try to set that up. But I'll see everybody soon. Try to watch my my latest video. Okay, talk to you later.